I'm an angel investor and I'm going to talk about how to raise capital for your startup. So when people are talking about how to get investors into their startup, here are some things you really need to know in order to get across to angels or investors of any type. One, you have to understand your funding needs. What is the amount of capital you need, right? One of the biggest issues that happens, and I've invested money into startups before, and then they come back and they need more money, right? A month later, a week later. That's frustrating. It's like, no, you need to know how much you need for the next 6 months at least, for the next year, your runway. How much capital do you need and what will you be using it for? Are you using it for product development? Are you using it for marketing, sales? Are you using it for security? What are you utilizing this investment for, right? Are you using it to hire more people in a specific area, department, etc.? Know that. Then you also need to understand what funding stage are you in. So are you in the seed stage? Are you Series A, Series B, Series C? These are things which you can look up online what it means. I'm going to dive into more friend and family round and series and seed stages or pre-seed. I'm mixing seed and pre-seed together. I'm going to talk about that more in this video because most of the people who are watching this video this is tailored towards that. When you're in the Series A, Series B, especially anything past Series A, you probably have some mentors, you have some advisors around, you have a structure, you can go to a bank or a law firm to help you work through some of these things. And when knowing the series you're in, what type of investor is suitable for you? Is it friends and family? Angels? Are you looking at VC, right? What are you looking at crowdfunding? What type of investor makes sense for your round? So the next thing I'll say is having a really strong business plan / business ideas of a business model or business concept. And I say ideas because it varies, right? If you are a very strong founder and you have done this and executed before, you may not need as much long thought out plan versus if you are a new founder and this is your first business or this is your second business and the first one failed, you may need to proof of concept a bit more. You need to show that you really thought this out. You might need to show you've tested the market, etc. So having a strong business plan, it's not the same type of document you take to a bank, especially if you're very early in your business. It's not that type of document, but you need to understand your business plan. We understand there'll be pivots. We understand things will change, especially angels should understand this. People who are funding seed rounds should also understand this, but we need to know that you've thought it through. We'll give more leeway if you are a serial founder that has had a successful exit before. Then we're like, okay, you know how to build up a company, you know how to ramp, you know how to pivot, you know what's necessary. So there may be less diligence on that end, but if you're the vast majority of people who have not exited already, and exit means you've sold the company or you've IPO'd, right? If you've not successfully exited before, you're going to run through a lot more hurdles. Right? So when you're doing this, your business plan is really going to be presented in your pitch deck, right? So your introduction, you're going to talk about the problem that's in the world and how you can solve it, right? You're also going to talk about the market opportunity, right? So what is the total market? How much you plan to acquire? Don't say, hey, I want to acquire 1% of this market. That's not as enticing to investors as you may think it is, right? Or a few sharks that take most of the market and everybody's fighting out for that other percent. That 1% you think that's super attainable is actually probably the most difficult thing to achieve. It's better to say, hey, we're going to come in and trying to be the top 2 or 3 players in the space. That's what we want to be. That's what we believe we can be. That's a better story than, hey, we're just trying to attack 1% of that. If it looks like that, I would say then you need to segment the market a bit more and talk about your core customers, not just say, hey, we're going to capture the whole hair care space. Say, no, we're going to capture the hair care space for people who are just coming out of college and are Black or Latino, right? So saying that and saying, okay, this is space, we're going to aim to capture 50% of this market value or 40% of this market value. And that's how it goes, something like that. Product. So this is where you might have an MVP, minimum viable product, you might not, but demonstrating the product is a really good thing you can do during your pitch. Your go-to market strategy, how do you plan to get your first few clients or how do you plan to ramp up your first few clients? Even if it's a great idea, it doesn't matter if your team can't execute. So in the team, you're trying to show us why should we trust you and put money in you and the people around you? Who have you recruited? Who has bought in, right? We shouldn't be the first people you sell to, right? First, you have sold to either your customers or you built a team, right? That's the first people who you've made the sale to about your vision, your idea. Financials, meaning the business model. Okay, you're going to get X amount percent. This is going to be your cost breakdown. This is your revenue breakdown. This is your revenue breakdown. These are your projections over 5 years, etc. Look, we look at that. Some people get excited. I tend to look at pitch decks and I'm not really looking at the projections that much. I want to see, okay, is this person a big idea person, a small idea? Can this person execute if this becomes a really big idea, right? What's going to happen if this becomes a really small idea? So these are things that I'm time balancing. Other angels have their way. VCs definitely have their own way of doing things. This is something to think about. And finally, what's your funding ask, or what's your ask? What are you looking to ask them? Hey, we're looking to raise $500,000 at a $5 million valuation utilizing a safe note, right? I can dive into safe notes in another vehicle. What I would really suggest for most of you, this is not legal advice. Please talk to an attorney. I know I'm an attorney, but I am not giving you legal advice. What you may want to do is get a safe note because it makes valuation easier. What you can do within your safe note is you can put a cap saying, okay, if at a later round somebody comes in, or if we get priced at a later round, you're going to be protected where the valuation won't go above this certain point, right? And why is that helpful? Because at this point, you're too young to really know, or you're too new to really know what is your company's valuation. Are you a $1 million company? Are you a $2 million? What is the company worth right now? It's too early to really know that. And instead of fighting that out, try to figure out what your limits are in terms of how much equity you want to give up now versus how much you're trying to raise. And a safe note is a faster way that you can do that. It's both understood by the entrepreneurs, is understood by the founder community, and also by the angel community and the investor community, plus our attorneys. It's easy for us to talk around that, develop that. There are caps on safe notes. There's discount rates. There's some tools you can utilize within that to protect yourself, to protect the angels, etc. Everyone wants to make sure they're making a good investment, and you also want to make sure you're not getting diluted too much. So when you're doing this, and you have to identify who are your potential investors. So we talk angel investors. So angel investors, we are individuals that typically invest in early stage startups. So we're maybe the friends and family round, the pre-seed round, the seed round. These are people who are really helping you when you don't have a ton of traction and you really haven't confirmed product market fit, at least not product market fit in a huge vertical. So this is where we can help you, right? We can go and give money where institutions, bigger investors may not be looking to invest as much. And angels may be typically investing, depending on the country, $5,000 to $100,000. It's rare to get up onto the six-figure side with a single angel, but it is possible. So key thing with angels, they often provide a smaller amount of capital, but they can be more flexible. So venture capital, VC firms, venture capital firms are firms that invest in startups, and they invest a larger amount into high growth companies, right? So they may be writing 6-figure checks, 7-figure checks. So they're writing these big chunks, but they're typically looking at you seed stage or later, usually Series A, Series B, etc. So that's when VC firms are looking at you. It's going to be very unusual, or it's very rare if a VC firm is looking at you in your pre-seed or seed. That's very rare. Incubators and accelerators. So these are programs that are programs, organizations, companies that have set up to help you scale up your company. So you usually have to interview to get into one. And then they typically, as part of the package for the training, the mentorship, the location, sometimes you're able to work in it. It's like a co-working space. They take a piece of your company, right, in order to do that. And typically at the end of the incubation or acceleration space, they have something called like a demo day where they introduce you to investors and you pitch to them. You may also have the opportunity to connect with investors throughout. This is a great opportunity for people who are looking to grow their network, who need some help, etc. And it's a good ecosystem for that. There's also grants and competition. So the government, institutions, nonprofits, etc., they may run some programs for startups and say, hey, go pitch, and we'll give you. Or maybe there's a problem they're really trying to solve, and they're trying to give some money in order to help alleviate poverty in low income environments. And you have a startup that's doing something similar. They want to help fund that because that's their agenda. So these programs exist. You may have to do some digging and you have to compete to win them. But the good thing with these grants and these competitions, usually you don't have to give up equity. So that's something that happens as well. But you may have to keep some statistics for grants. They may want you to give them some updates in some ways. To raise money, you have to attend events, build relationships, get people to know you, know your business, to be able to trust you. Because when we're giving money to you, right, this is not secured money. We're not giving money against a house, right, or some tangible asset. Usually if you're investing in a startup, the most money they have is the capital that you've given them, right? So knowing that there has to be a high level of trust, both in your character and in your competence, right, of how to raise capital for a startup. Please let us know, what's your startup? How much money are you looking to raise? Don't forget to like, share, and comment. God bless you.